So what if the most important AI company in the world isn't, the one making those flashy headline-grabbing chips everyone is constantly talking about?
Right, the ones you see all over the news every single day.
Exactly. What if it's the company quietly building, like the custom plumbing for the massive data centers of the future?
Which is arguably just as critical,
Well,
honestly.
absolutely. So today is April 20th, 2026, and we are diving deep into Broadcom, ticker symbol AVGO.
A massive player.
Yeah, and just this past Friday, Broadcom closed at $406.54. And that single closing price capped off this just staggering 30% surge in only 30 days.
Which is a wild run for a company that big.
I mean, we are looking at a $1.92 trillion market cap giant, right? Just adding hundreds of billions of dollars in value in a matter of weeks.
Yeah, it's almost hard to wrap your head around those numbers.
It really is. But here's the catch. Underneath that massive run, the technical indicators are practically screaming, sell.
Oh, loudly. Very loudly.
Right. And some very prominent analysts are warning that investors are just walking straight into a classic value trap.
Which brings up the big question for the listener, really.
Exactly. Are retail traders stepping right into a buzzsaw here? Or is this near $2 trillion behemoth somehow actually undervalued?
It is, honestly, the defining financial tension of the market right now.
Totally.
Because you have the charts signaling severe short-term exhaustion, right? But then the fundamental cash flows look absolutely unstoppable.
Yeah, the cash is just flowing.
And then you have the people actually running the company, executing trades that seem, well, entirely disconnected from the dominant Wall Street narrative.
Which is exactly why we are pulling apart the raw financial statements, the technical setups, the insider trading disclosures, and the institutional block buys today.
We're looking at all of it.
We really are. Now, a quick reminder before we get into the weeds. We're here to analyze the data and debate the market mechanics for you.
Right. This is strictly an educational deep dive.
Exactly. Not financial advice. Oh, and if you want to help us out, it is absolutely compulsory that you like the video, subscribe to our YouTube channel, and leave us your comments and feedback below.
We really need to know what you think of this stock.
Yes, definitely let us know. So, okay, let's start right at the core of the underlying business because, I mean, a 30% rip in 30 days doesn't happen without serious institutional conviction.
No, it definitely doesn't.
And that conviction usually traces back to the income statement.
Exactly. The fundamental anchor here is Broadcom's Q1 fiscal year 2026 performance.
And the numbers are undeniably massive.
Oh, they are. They posted record revenue of $19.31 billion for the quarter.
Wow.
Yeah, which represents a 29% year-over-year growth rate.
So just to put that in perspective, when a company's already generating roughly $64 billion annually.
Right, which was their fiscal year 2025 revenue.
Exactly, $63.89 billion to be exact. And they were pulling in over $23 billion in net income a year. Accelerating top-line growth by nearly 30% at that scale requires, an unprecedented catalyst.
It's not just regular growth at that point. Oh, and their non-GAAP net income for this past Q1 was $10.19 billion, by the way.
Wait, $10.19 billion for a single quarter?
Yeah, that's $2.05 per share.
That's insane. And the sources pinpoint exactly what that catalyst is. It's not some broad macroeconomic lift across their legacy broadband stuff.
No, it's incredibly specific.
It's razor-focused. AI revenue specifically hit $8.4 billion for the quarter.
Which is just
106% year-over-year explosion. They literally more than doubled their AI revenue footprint in a 12-month span.
What's fascinating here is that the 106% growth validates their entire strategy in the custom AI accelerator space.
Right, because we constantly hear about, off-the-shelf AI chips.
Yeah, the incredibly powerful mass-produced GPUs that companies buy by the tens of thousands.
But Broadcom operates on a completely different model, right?
They do. They dominate the market for ASICs, application-specific integrated circuits.
Right. So they aren't selling a one-size-fits-all product. They are basically embedding their engineering teams directly with hyperscalers.
Like Google and Meta.
Exactly, to co-design silicon that does exactly what those specific data centers require.
Precisely.
No.
Because if a tech giant wants to run a highly specific proprietary algorithmic model, a general-purpose GPU might actually be really inefficient.
It's too generic.
Yeah. So Broadcom comes in and builds a custom circuit deeply integrated with the hyperscaler's own architecture. And that creates an incredibly sticky revenue stream.
Oh, I bet. Once a company like Google anchors its infrastructure on a custom TPU.
Right, a tensor processing unit co-designed with Broadcom.
Yeah, the switching costs become astronomically high. You can't just rip that out and replace it with a competitor's chip.
No, you'd have to re-architect your entire data center.
And that stickiness is translating into pure cash. Like looking at the balance sheet, total assets sit at 171.09 billion against 65.14 billion in total debt.
Which is a solid position.
But the metric that really stands out is the free cash flow. In Q1 alone, free cash flow came in at $8.01 billion.
It's an incredible margin.
Okay, let's unpack this for a second. Generating $8.01 billion in free cash flow on $19.31 billion in revenue is a 41% margin.
It's basically a money printing machine.
It really is. That's like earning $100, paying every single one of your bills, your taxes, all your expenses, and still having $41 left over to just stuff in the mattress or give back to your family.
That's a great way to put it. And it speaks to their broader corporate strategy, too.
How so?
Well, they aren't just hoarding that cash to offset debt or pad the balance sheet. They aggressively return it to maintain the stock's premium multiple.
Right, the shareholder returns were massive.
Exactly. In Q1, they deployed $10.9 billion back to shareholders.
Wow.
Yeah, $3.1 billion through dividends and a massive $7.8 billion in stock buybacks.
And retiring that much float directly supports the price action we've seen, pushing it near that 52-week high of $414.61.
While the 52-week low was way down at $161.61, just for context.
And with high trading volume, too, like 20.58 million. But okay, here's where it gets really interesting.
The contradictions.
Yes. That aggressive buyback program creates a glaring contradiction when we look at the insider trading reports.
The narrative completely fractures here.
It does. If the company is buying back $7.8 billion of its own stock because they believe it's undervalued, why on earth are the top executives simultaneously dumping their own shares?
It's the ultimate paradox of this specific tape.
Like in March 2026, major officers, specifically CEO Hock Tan and CFO Kirsten Spears, heavily sold shares at price points between $317 and $348.
The corporate treasury is buying while the executives are selling.
Let's dig into that, because Hock Tan didn't build a $1.9 trillion empire by having weak hands.
Sure.
If the CEO is cashing out aggressively at $348, isn't he fundamentally signaling that the near-term upside is capped?
You'd think so, on the surface.
Right. I mean, he left over $60 a share on the table, based on Friday's 406 close. If the insiders want out, isn't the retail trader who buys at 406 just becoming the ultimate bag holder?
It's a highly valid concern, it really is.
Mm.
But if we connect this to the bigger picture, you have to filter executive sales through the structural mechanics of how they get compensated.
Okay, fair.
Founders and CEOs of mega-cap tech firms receive the vast majority of their net worth in equity.
Right.
So they frequently execute 10b5-1 trading plans where the sales are scheduled months or even years in advance to trigger at specific price targets or dates.
So they aren't just logging into E-Trade and mashing the sell button because they had a bad day.
Exactly. It's explicitly done to avoid any allegations of trading on material non-public information.
So it's entirely possible these sales were locked into a schedule back when the stock was trading at its 52-week low of 161, and hitting the mid-300s just triggered an automated diversification event.
Precisely. Tax obligations, estate planning, and simple portfolio rebalancing drive these sales just as often as, fundamental bearishness.
But you can't ignore the optics.
Oh, the optics are terrible. When the CFO and the CEO are unloading heavy volume at 340, it introduces a massive layer of psychological resistance for the market.
Absolutely. But wait, we have to weigh that insider selling against what the institutional block buyers are doing, right?
Yes, the super investors.
Because the filings show that while the insiders were selling tens of thousands of shares, massive institutional players were loading up on millions.
In stark contrast.
Yeah. Point72, which is managed by Steve Cohen, and Fisher Asset Management both acquired over 1.2 million shares each recently.
That institutional accumulation is the counterweight to the insider sales.
It has to be.
When a fund like Point72 takes down a 1.2 million share block at these valuations, they are not trading the next quarter's earnings whisper.
No, they're playing a much longer game.
They are taking a structural position based on long-term macro dominance. They're looking at the 2027 projections, the $100 billion AI market forecasts, and determining that Broadcom just holds a monopolistic grip on this space.
Unfazed by the short-term price action the insiders might be capitalizing on.
Exactly.
But those massive institutional buys drastically warp the short-term technical landscape for the regular trader.
Oh, absolutely.
When billions of dollars of institutional capital flood into a stock in a 30-day window, you get the exact chart setup we are staring at right now.
A very extended chart.
Yeah, let's look at the technicals, because the underlying fundamentals only tell us what Wall Street thinks the company is worth over the next 5 years. The technicals tell us the actual signals the retail trader is facing today.
And right now, those technicals are flashing severe short-term exhaustion warnings.
They really are. I mean, the primary trend is undeniably bullish. The stock is at 406, which is wildly extended above its 50-day moving average of $333.43.
And its 200-day moving average of $333.22.
Right. And the max ED is sitting at 9.30, confirming that the momentum is still firmly bullish.
But
Yeah, the metric setting off alarms across the analyst notes is the relative strength index.
the RSI,
The RSI is currently sitting at a scorching 79.1.
which is incredibly high.
For a listener trying to read the chart, an RSI of 79.1 doesn't just mean strong momentum, it screams significantly overbought.
Generally, anything over 70 indicates the stock has moved way too far, too fast.
Right, so it feels like retail traders are jumping in right at the $414 resistance level out of pure FOMO. Isn't this exactly how retail gets trapped?
That is the exact anatomy of the retail trap.
I knew it.
An RSI of 79.1 essentially guarantees near-term turbulence. Market mechanics dictate that a stock just cannot sustain an almost vertical 30% ascent without institutional profit-taking.
It has to cool off.
Exactly. What typically happens is a healthy, routine 3 to 5% technical pullback to relieve that RSI tension.
But the retail guy doesn't see that coming.
No, the trap springs when retail traders buy the absolute top at the 414.61 resistance level, completely ignoring the short-term volatility.
And when that healthy 5% pullback happens, their position goes deep into the red immediately.
They panic.
They panic, they assume the AI bubble just burst, and they sell for a loss right as the stock hits structural support.
Precisely. They get chopped up by standard volatility because they ignored key support levels.
So what are those support levels to watch?
Well, if this stock rotates down to cool off, the initial floor is the recent swing low, around $392.35.
Okay, 992.
If that breaks, the major battleground becomes the 50-day moving average down at 382.01. Buying at 406 with an RSI of 79 means you're accepting a massive amount of near-term downside risk just to chase momentum.
Conversely, if the institutional buying just completely overpowers those overbought signals and it breaks through that 414 ceiling, the next psychological resistance target mapped out is $430.
Which brings us to the core debate surrounding Broadcom right now.
Yes, the ultimate debate. By combining the underlying fundamental cash flow with this overheated short-term chart, we have to zoom out.
Right. What are the best and worst case scenarios for this stock?
Exactly. Are we looking at an undervalued giant or an overvalued value trap? Because right now, analyst consensus is a moderate buy.
With an average price target of $435.30.
But the spread is wild. The low target is 300, and Truist Financial has a high target of 545.
That massive $245 spread indicates Wall Street is fundamentally divided on how to value this business.
So let's examine the bear case first, because the valuation metrics are historically stretched.
Oh, they are.
The trailing PE ratio is a whopping 79.3, and the price-to-sales ratio is 25x. That's significantly higher than the industry average.
You cannot justify a 25x sales multiple on a near $2 trillion company unless execution going forward is absolutely flawless.
Right. Paying $25 for every single dollar of gross revenue generated means the market has priced out all potential macro risks.
And there are significant macroeconomic downside risks right now.
Like geopolitical tensions, aggressive tariff policies.
And the constant threat of tightening China export restrictions.
Right, which could instantly bottleneck their semiconductor supply chains.
Or outright sever major revenue streams. And beyond the macro environment, the bears are heavily focused on internal gross margin dilution.
This is a really interesting point.
It is. We established earlier that the 106% AI revenue growth is largely driven by custom XPUs and ASICs.
Yeah.
But the economics of that business are fundamentally different from Broadcom's legacy products. When they sell proprietary off-the-shelf software networking switches, the margins are incredibly high.
Right.
But when they co-design a custom chip alongside a hyperscaler like Google or Meta, those tech giants wield massive negotiating leverage.
Oh, I see. Google isn't going to pay a massive premium on a chip they helped design.
Exactly. Broadcom accepts a lower gross margin on those specific custom AI deals in exchange for massive volume.
So what does this all mean for the listener? A PE of 79.3 sounds like a textbook overvalued trap, waiting for a single bad earnings call to trigger a massive repricing.
This raises an important question, though. How do traditional valuation metrics fail to capture unprecedented hypergrowth technological shifts?
Okay, lay out the bull case for us then. How does Truist Financial justify a $545 price target?
The bulls argue that an AI discount actually still exists here based on future earnings projections.
Wait, a discount at these prices?
Hear me out. Broadcom isn't just projecting growth. They have a tangible $73 billion order backlog stretching over the next 18 months.
Okay, a $73 billion backlog sounds like an unstoppable juggernaut. That is contracted, guaranteed demand from the largest capital allocators on the planet.
Exactly. And when you factor in projected industry-wide AI revenue exceeding $100 billion by 2027,
Right.
Broadcom's absolute dominance in the ASIC market for hyperscalers positions them to capture a massive slice of that.
Huh.
The bulls also point to the strategic integration of VMware.
Ah, the software side.
Yes. Broadcom's historical playbook is to acquire foundational software companies, streamline operations, and integrate them.
So it's a dual engine model. They lock you in on the hardware side with deeply embedded custom silicon.
Like the Google TPU contracts.
Right. And then they lock you in on the enterprise software side with VMware platforms. You combine the hardware backlog with the high margin recurring software revenue, and suddenly that 79 PE ratio starts to compress very rapidly over the next 4 quarters as those earnings materialize.
The bulls argue the sheer volume of Google and Meta orders justifies the premium price today.
So paying $406 a share might actually be a bargain long term.
Exactly.
It's a fascinating standoff. Broadcom is this cash-generating behemoth with incredible AI growth. But the charts are flashing short-term.
Right. If you are a short-term trader, brace for a technical pullback due to the RSI. But if you are a long-term investor, you're betting the fundamental reality of the business eventually overtakes the short-term noise.
That synthesis really brings the entire Broadcom narrative into focus. As always, our goal today was to pull back the curtain on the mechanics driving this specific ticker purely for educational purposes.
Not financial advice. Do your own due diligence.
Exactly. But before we go, we want to leave you with a final provocative thought to mull over.
The existential risk.
Yeah. We talked about how Broadcom's massive bull case relies on building custom chips for tech giants like Google and Meta. But here's something to think about. As those hyperscalers get bigger and more powerful, what happens to Broadcom if Google and Meta eventually decide they have the resources to design and manufacture all their own custom silicon completely in-house?
Just cutting out the middleman entirely.
Exactly. Let us know your thoughts in the comments on how that dynamic plays out. And don't forget to like and subscribe. We'll see you on the next deep dive.